Investors are rapidly losing confidence in the stock market as it hasn't been able to continue its upward trend without QE4 to support it. Fear and instability have taken hold and taken over. If this continues, eventually we will have our trigger event and nothing will stop it. But of course, the central bankers will do their dirty work instead. The question is, why haven't they intervened yet? You came here for the truth, so let me unveil that for you. Today we're going to look at how the stock market was smashed 500 points plus in this trading session in April of 2018 on the 24th. You will see what has happened and why, oh why, haven't the central bankers stepped in to engage in QE4 or lowering of interest rates? What do they know? Well, you can see here for yourself. 24,000 just barely creeping above in this trading session. It closed only 424 points down. It had been rescued towards the end of the day. But if you take a look at where the stock market was back in January and see where we are today, this is a 10% decline. So we are still down 10% from the peak. That is a significant number, and I believe we should be keeping our eyes peeled on this. So you're seeing here that individuals have been pouring in their money because they're seeing a 10% decline. It's as if they see a sale for 10% because they believe that the market will simply go up further. I don't think we're going to be able to get this market further up without some sort of intervention. Now, will they engage in QE4? I don't really know, but ultimately they need it. That's a fact. You could have other central banks around the world simply pumping their money into this market and it will find its way up higher. But it will take quite a bit to get this to go. So we'll see what happens. Ultimately, it's struggling right now because it needs more stimulus. I'm not suggesting that stimulus is a good thing. I'm just telling it like it is. Looking at Google, Facebook, Netflix, Microsoft, and Amazon all taking a beating today. So you'll see this right here. Again, we're looking at the 24th of April trading session. Look at what has happened. FANG stocks led the way, and I'll show you more about that in just a moment. What about bank stocks? You could see they all declined together. Now, people will say you can be diversified because you'll invest in tech, you'll invest in banking, you'll invest in all of these different other sectors, and you're going to be fine. That's diversified. But that's not the way it works. When the fear is there, the fragility is there, and you will see the markets tank. It happens in the short term and it happens in the long term. We saw the same thing happening during the financial crisis, a significant event. Everything dropped. Even the things that you would deem as safe havens were seeming to drop. People were pulling the money out. They were taking cash. They were doing whatever they could to save their money, or at least trying to do so. So when you have this idea in your mind that what diversification means, I hope that we're on the same page and it's not investing in a basket of stocks. I don't think that's a good sense of diversification. Here you can see the FANG Plus Index, and they are exhibiting a head and shoulders pattern right now. The trend appears to be on the way down. We'll see the way it goes. But if the trend continues, this pattern will show us that the market is heading down. Like I said, if we see intervention, QE, and so on, the market will simply go higher. Here, more markets declining. Look at this. Now, it's very important to watch particular indicators. There's US debt, which is always being looked at, constantly throughout the day. A lot of money's flowing in, and ultimately it's a very important statistic that we need to keep our eyes on, if not daily, then at least weekly, because it shows us certain things. Now, you as an individual, and you're there, you're working your 9 to 5, you're paying your taxes, this and that. Maybe it doesn't necessarily mean much to you, but to the stock market, to the health of the stock market, these are what you need to be looking at, among so many other things. The 2-year yield has not been this high since basically right at the financial crisis timeframe. That's worrisome, because we can see what had happened, previous to that. This territory here is definitely something that we need to be concerned about. I don't know if it's going to necessarily take on the same pattern, but we'll definitely keep our eyes on it. The 30-year yield, you can see where it has gone, and of course it is absolutely in the opposite direction right now as the Nasdaq. Okay. By the way, looking at yields, all these junk bond yields, which should be yielding good returns for investors. It should be something that if an investor wants to take a risk, they want to add a little bit more potential yield to their portfolio, they would invest in something a little more risky, let's say, right? But that's, all these terms are getting confused because supposedly the things that are high yield bonds, particularly out of Europe, they're not getting that yield anymore. Everything's messed up. After this crisis is over, they will need to rewrite the economics textbooks. They are no longer valid because of the central bank intervention. The US 10-year yield crossing above the 3% mark. Okay, you'll see here, hasn't done that since the taper tantrum. Many people, including some analysts in an article I was reading today, said 3% is just a number. Don't worry about it. Everything is going to be fine. Well, you're right. 3% really is just a number. Doesn't mean anything. Whether it's 3 or 3.1 or 3.2, doesn't matter. However, you have to understand that there are computer algorithms which are trading on all of this, and you better believe that they are programmed at certain levels to do certain actions, whether it's buy or sell or short or whatever, it doesn't matter. They're being programmed. They are waiting for certain, things to occur, whether that is geopolitical issues, whether that is something that's going in the stock market, the bond market, and whatever. You can see that this here is one event that is important. Okay, it's not necessarily the most critical thing ever, but it's important, and we crossed that line today. Now, speaking of central bank intervention, the worst offender of central bank intervention in history is Japan. They have actually destroyed their stock, bond, and every other market out there. It's destroyed. Okay? The trading volume that they are experiencing right now is so low compared to where it should be. And that's a direct correlation to their balance sheet. They've been printing so much money that they've been essentially pushing out all of the other investors. I've covered it here on the channel before, talking about how the fact that basically Japan's central bank buys so much of their debt that there's nobody else that can actually get in and buy it. It's unbelievable, truly unbelievable how far they've gone. And every video I talk about this, there's always some people in the comments suggesting Japan is the model of success. I don't know how that meme got out there, but those in the financial industry, I've heard them say it. I've heard incompetent day traders talking about this. And I've heard just the general public who happens to think they know a thing or two. I see it differently. Don't go anywhere. Make sure you click on part 2 of this video. I'm going to talk about GDP. I'm going to talk about real estate and more. See you there.